Hi everybody, this is Ellman, the blue-collar investor, with today's covered call writing question of the day, which comes from Len of Sarasota, Florida. Alan, you make a good case for not holding a stock where there'll be an earnings announcement before expiration. You also allow for the possibility of rolling out or rolling out and up where the stock seems likely to rise further. Would you consider rolling out even when there's an upcoming earnings announcement before the new expiration date? Well, Len, this is a very important question because it's an area where a lot of covered call writers end up making serious mistakes where you could lose an entire month's covered call writing profit simply by having an earnings report impact your bottom line. So let's first take a look at the situation where you would consider rolling out. Now, in the screenshot you see right now, you would consider rolling out if the price of the stock is higher than the previous strike price sold. So let's take an example where we bought a stock for $48, sold the $50 call, and on or near expiration Friday, the price of the stock is $52. Well, you know that if you take no action whatsoever, those shares will be sold the Saturday after expiration Friday for $50 a share. You'll no longer own the shares, and you'll have the cash from the sale in your account where you could use the next week. As a matter of fact, even if those shares are $50.01, your shares will be sold if you take no action. Now, you have to check to make sure the stock still meets your system criteria. And in this case, it probably will because the price of the stock is holding or even rising. But you also have to make sure that there's no earnings report coming out prior to expiration the following month. Now, let me show you how your watch list should look in regards to this issue. In the screenshot in front of you, you could see the Blue Collar Investor Premium Stock Report, the actual running list, which is our watch list. Now, the red arrow points to some gold rows. Those gold rows represent stocks that have met and passed all of our system screens, with the exception that there's an earnings report in the current contract cycle. So therefore, those stocks are not eligible for covered call writing until the earnings report date passes. Now, the green arrow below that represents the stocks that are reporting in the following month. So from the gold rows down to the black broken arrow, those shares are projected to report prior to expiration Friday of the next contract cycle. So those shares are not eligible for rolling out or rolling out and up, and not even eligible for covered call writing until the report passes. And finally, you'll notice the red circle at the top, and those represent the actual projected earnings report dates. So our report gets even that specific. Now, for those of you that are going to do your own screening and not allow BCI to do it for you, a very reliable site for projected earnings reports is earningswhispers.com. So what do we do then if the price of the stock is higher than the current strike price sold? What are our choices? Well, the first choice is to do nothing at all. If we do nothing at all and the price of the stock ends up 1 penny higher than the strike price, those shares will be sold without any action needed on our part. The cash will be in our account, and we could use that cash the following week to enter new covered call writing positions. The other choice, which is not actually part of the BCI methodology, but a lot of our members like to use it, and I do from time to time myself, is to simply buy back the near month option, hold on to the stock through the earnings report, but not sell a call option until the report passes. This way we have the opportunity to benefit from a favorable report. And if that happens and the price goes up, we wait for the price to settle a bit and then we're free to sell a call option for the next contract cycle, thereby getting the best of both worlds. So, Len, there you have it, a very, very critical question, an area where a lot of covered call writers do make a mistake. However, now that you've asked the question, hopefully you and all of our viewers that have watched this video will make a note of it and avoid this particular issue. So, Len, I thank you so much for that question, and I thank all of you out there for viewing this video. I hope you found it useful. And as always, this is Ellman, the Blue Collar Investor. Take care, everybody.